Traders, welcome to the Independent Quant, where I help you turn your trading ideas into algorithmic strategies without having to worry about all the code and theory that may be associated with it. I'm the founder of the Independent Quant, Luis, and in this video, we're going to talk about how to think like a quant. So we're going to talk on three things. We're going to talk about emotions, understanding an edge in probabilistic thinking, and common mental traps that traders fall into. So emotions. I consider them part of trader psychology. Many traders tell you that you need to turn those off. That's not really feasible. We're human beings. So I'm from the camp where it's understanding what your state of mind is and what your emotional state is in order to determining if you're in the right state of mind to trade. One thing that quantitative trading allows us to do is really not worry about that as much, in the sense that since we are using a data-driven approach and we're using the computer's logic, meaning the logic that we gave the computer, let's be correct, the logic that we gave the computer to understand what are trading opportunities, we don't have to become emotionally attached or involved with what's happening in the market at that given time, and the computer is following the instructions and the rules to a T. And that's how you become successful as a trader, is following rules. So since we have this inanimate object that all it can do is compute and follow rules, take care of a lot of that for us, it takes that load off of our shoulders and opens up the door really to become successful sooner. Now, it doesn't completely remove emotions. That is, I believe, a falsehood. It reduces your emotions. And when you've got real money on the line, I don't care if it's you in front of the computer or a computer doing it for you, you're going to have some level of attachment, emotional attachment to it. I mean, it's your money. You worked hard for it, right? So you're cautious about it. You want to see what the computer's doing. You want to supervise it. That's fine to a point. The way I've described having algorithms is that I'm an employer, I'm the business owner, and that is my employee. So yes, I do have to supervise it, but I don't have to micromanage it, right? And when you get to the point where you're micromanaging the algorithm, then you may be interfering with how it's supposed to work. You may be stopping it when it should run its course. You just need to understand when to turn it on and when to turn it off. And you cannot babysit it and mess with it as it's trading. That completely defeats the purpose of why you did this in the first place. But the reason you do that is because of that emotional attachment that you have. So that's why I say it reduces, but it doesn't eliminate the emotional aspect of trading. So with that, it opens up, I guess, the next topic of conversation, which is understanding edge, probabilities, and expectancy, which is every trading strategy needs to have an edge in order for it to be profitable in the long run. It needs to have a statistical advantage of some kind in the market. And quantitative trading helps us find those easier than other methods, because we can backtest and iterate and find those opportunities just by having a couple of ideas and shifting those ideas around, or seeing what other people are doing and modifying those for our needs. As you do that, though, the most important thing, regardless if you're a quantitative trader or a systematic trader, is that you understand that probabilities matter. And we as traders are probabilistic thinkers. What we do, we don't ever know what the outcome of any trade that we're going to put on is. What we do is probabilistic. So we have to completely embrace this probabilistic world. What I mean by that is that you have taken ownership of that reality. And it sounds easy. It sounds like, it's probabilities. I get it. I don't have to think any more about that. But there's a difference between understanding it academically in your mind and understanding that ingrained within yourself. Once you put that trade on, you're thinking probabilistically because you're indifferent as to whether or not it makes money or not. That's what probabilistic thinking means, is that you don't know what's going to happen and you accepted it. But if you're anxious in any way or have emotional stress still, it's probably an indicator that you haven't embraced the probabilities. Expectancy is a way to measure how good your strategy is when you take into account what your average winners and your average losers are and what your win rate percentage is. When you take all those factors together, if you have a positive expectancy, which we can calculate by way of backtesting our strategies, then we can have an expectation that our strategy is going to work really well in the live market. Now, that's provided, of course, not just that it's profitable, but that it's also adhering to your risk management plan. So expectancy is another powerful tool that we have available to us as quantitative traders. Now let's talk about some common traps that traders fall into. We've got revenge trading. I have fallen victim to this many times in my early trading career. Revenge trading is when you're just having a bad day and the trades you're taking, they're just not working out. And you have this emotional thing come over you where you decide that you're going to show the market who's boss and you're going to get that money back by all means necessary. Well, the market always wins in that condition because you are no longer following rules. You're taking trades because you want your money back. It's not a good place to be. Quant traders do not trade this way because we follow rules. Next is FOMO, a fear of missing out. This is where you see a trading condition that you should have entered the position in, but you did not. And you see price or the conditions presenting themselves that would have made you profitable happening right before your eyes. And you decide, nope, I'm not going to miss on this. And you jump on board. When you do that, you increase your risk. And it could be a losing trade anyway, but now you have more risk when you did that. And usually that's what happens. It turns around on you and you're out a lot more money than had you just sat the trade out. All those things can be addressed using quantitative strategies because you're using data-driven and rules-based trading. So you free yourself from having to carry the burden of revenge trading and fear of missing out. If what I've shared with you is something that you find really interesting and you want to learn more, I do have a mini course available on the Independent Quant website. Just navigate on over there. While you're there, sign up for the mini course and sign up for our newsletter. I'd love to be able to see you one day in our community and help you get to your trading goals. And if you're not ready to get started, I'm building an algorithmic trade desk. It's my first venture and I'm doing this in public. So you'll be able to follow along and see how to do it right or how to do it wrong. So if you're willing to join me on that journey, I'd love for you to be part of it. Until then, I really look forward to seeing you guys again. Keep it green.